The Reserve Bank gave us an interest rate warning last week and said the global signs aren't looking good. In this week's Property Insider video, Dr. Andrew Wilson and I discuss the implications of the latest US inflation figures. We also discuss Reserve Bank Governor Philip Lowe's warnings, including his forecast for the property market and interest rates. So if you want to keep up to date with what's going on in our property markets, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. It's been an interesting week full of economic news. Firstly, the United States US inflation figures, they spooked the markets as there's no sign that inflation is abating over there. Then back home, Reserve Bank Governor Philip Lowe warned that the deteriorating global economy would make it hard for Australia to achieve a soft landing due to the economic buffeting that's underway. At his annual appearance before the House of Representatives Standing Committee on Economics, Dr. Lowe explained that the Reserve Bank wouldn't be deterred from more interest rate rises, and he expressed his doubts that the current 3.5% unemployment figure could be maintained. He was also worried that businesses currently using inflation as a cover-up for even higher prices, which of course only pushes up inflation even more. And he gave some thoughts on the property market. He explained he wouldn't be surprised to see house prices fall 10% from their peak. And he also said the Reserve Bank isn't to blame for housing affordability issues. He blamed the choices made by society. Well, that's interesting, and there's lots to unpack from Governor Lowe's speech and other important property news that I'd like to discuss. So I'm looking forward to this week's Property Insider chat with Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Markets. Hi, Andrew.
Yes, good morning, Michael, and certainly a comprehensive snapshot of what happened last week, and we've certainly got a lot to discuss.
Some would be suggesting the global signs aren't good. The outlook for house prices and shares seem to have worsened last week as interest rate expectations rose on the back of the economic problems in the United States, the high inflation that seems hard to budge, and in light of the Reserve Bank Governor Lowe indicating the Reserve Bank is going to keep raising interest rates because they're probably not at neutral levels yet. What are your thoughts on this, Andrew?
We've had some positive signs that Australia's inflation environment may be improving. It has, of course, been driven essentially by too much demand and not enough supply. We've seen individual factors in Australia contributing to that, and that has been firstly or primarily the sharp increase in house building costs as a result of the home builder policy last year from the previous government. We know that house building costs have increased by well over 20% over the past year. But the good news there, well, sort of good news, is that the rate of increase has now declined over the past 2 months. So even though they're still rising strongly, they're not rising as strongly as they did, Michael. So some signs there that all that development is being absorbed now, as it will, of course, over time. The conundrum is in I guess, a lot of instances that those that have purchased houses are being asked by builders to pay more because builders can't cover the extra costs. We're still seeing lower numbers of houses coming into the market in terms of building approvals. So once we do clear that backlog, we should get back to a more normalised environment in terms of building cost increases. So that's a positive going forward for the next inflation data, which is going to be very interesting because we've come to a whole new world now, finally joining the monthly inflation measure club, which everybody else does, but we're finally doing it. And just speaking about that, inflation data will be released in the third week of October, and that'll be for the September quarter. We will have a monthly inflation rate number for the first time, also the quarterly data. Not sure how that'll work its way into the narrative from the Reserve Bank for the November meeting, which obviously will be quite important. But the other factor is the price of oil. Price of oil is now fell to around about $80 US a barrel, showing some signs of moving back upwards, which is a bit of a concern. So the price of oil can be quite volatile, but in the shorter term, that has been good news for us at the Bowser. So that'll also factor its way into inflation. And that did work its way into a better result for the US on their August inflation numbers, but that was for headline inflation, which does take into account the price of oil. But their underlying inflation rate increased again, Michael, and that takes away the impact of volatile issues such as food and fuel. So they're very concerned about their outlook. And I think it's the point to the US versus Australia is that the US has very strong wages growth at the moment. It has a much more real-time response from wages to price changes, and workers have really been bidding up wages quite quickly in the US. And of course, that means they're out spending those wage increases, which is just fueling inflation. So inflation has moved from goods, particularly as a result of shortages through the stimulus period of COVID, and now it's moving into services, which reflects those higher wage costs. Now, we're not there yet, but there are some concerns that we're going to start fiddling with our wage setting system, which may see our inflationary outcomes move from goods to services, which would be very difficult to control, as the US is experiencing. Although it was interesting also, Michael, the US was confronted by a rail strike, or the potential of a rail strike, last week. So these are signs, of course, of workers getting a little edgy about high prices and wanting to be able to match them with higher wages. So the threat was for a strike from rail workers, which is the last thing the Biden government would have wanted with midterm elections just around the corner. So Biden actually worked as a mediator to solve that strike, but I'm not sure that the process of solving the strike have a very positive outcome for inflation, because those rail workers were given substantial wage rises, and that's likely to flow on through the economy. We're moving into that wages versus prices control environment now, which means that the outlook becomes even more clouded. So fingers crossed we don't start to get into that environment that the US is clearly suffering and pushing inflation up. But the good news, as you suggested, from the Reserve Bank governor, is that perhaps revealing those factors we've just discussed, that interest rates might peak a little lower and a little earlier than expected. Those current 0.5% increases may not be what we can expect going forwards. But of course, as you suggest, the outlook is certainly clouded. And we do have the US that will make their interest rate decision this week, Michael. And some are saying that they'll almost now be forced to go up 1 full percent. And that's quite sobering, really, because the US has already had 2 consecutive quarters of negative growth. This isn't going to help growth at all.
Well, Dr. Lowe suggested that real wages aren't going to go up for a while, that we are going to have to suffer some pain now, or the alternative is not to do anything and not counter inflation, and that's going to be a bigger problem. But he also gave some opinions on the property market. On the one hand, he said the Reserve Bank shouldn't be forecasting. And he's gotten into a bit of trouble over the last little while by making some forecasts and some suggestions which have been proven wrong. But one of them was that the property market could, and he said it's not a forecast, but it could drop 10% from its peaks.
If it walks like a duck and quacks like a duck, you know what I'm saying? He said, he mentioned the number 10%, and then he said, but it's not a forecast. And it's a little different to when the Reserve Bank was mentioning 15% recently, and also said, well, that's not a forecast. So I'm not sure what's going on here. But of course, the minute the number's mentioned, it becomes a forecast. Let's look at the real situation now as we stand, and it's likely we'll see house prices down by around about, well, they're down by around about 2% nationally at the moment, and that's capital city national median house prices, the weighted average, and it's down by around about 2% at the moment. So we've still got a bit of a way to go to fall by another 8%, particularly given that we're seeing some just early signs, Michael. We've discussed this over recent weeks of the markets just maybe finding their way to the bottom, particularly Sydney and Melbourne. And it's not just the fact that price declines are moderating, still falling, but not falling as fast. There's also some correlating data, such as auction clearance rates and days on market, that are pointing towards those larger markets, Melbourne and Sydney, which of course is really the national market, is basically Melbourne and Sydney, what happens there, that they may be starting to improve their lot. And we certainly have some way to go before we can call it, but the signs are positive there that they're having an improved spring market given the circumstances. So maybe the Reserve Bank governor will make another non-forecast going forward of a little bit lower than his latest non-forecast that he produced last week.
Well, he also talked about how high house prices are, and it's not the Reserve Bank's fault. Now, I'd be interested on your thoughts in a moment on how high house prices really are, if they are high. But he said It's not about interest rates. It's about the choices we made as society that's given us higher house prices up. It's not the cost of construction, but it's really the cost of land and the fact that we've chosen to live in fantastic cities on the coast and that we all want a block of land rather than high density. That all makes sense. We do live in the best place in the world, the best countries, and in coastal cities. It really isn't interest rates. There's a lot of other factors that affect house prices.
Well, the bottom line, of course, Michael, is I'm not sure we make choices is appropriately describing the environment. It's about certain areas make certain choices, and that's just a phenomenon of not in my backyard that is really consistent in most developed economies. And of course, as he suggested, it's not high prices everywhere. I question the whole notion of high, and we'll talk about that in a second. But the restrictions on planning certainly are part of that environment. The point is that local governments have control of land planning and state governments. So, of course, it becomes more of a localised scenario. But the maturing nature of Australia's urban environment is such now that people are making choices towards apartments, are moving away from larger houses. Society now has different work, recreation choices, and that's almost inevitably moving towards choices in favour of higher density away from low density. And that's just the evolution of the urban environment. And we're seeing that particularly in the shortages emerging now for apartments in a city, particularly areas such as Brisbane that are now embracing higher density inner city living. So look, there's a mixed bag in terms of the reasons for this. But when we get back to these statements of high prices, I mean, the Reserve Bank governor's start to sound like a politician, Michael. I mean, where's his next gig? Is he looking to run for office somewhere?
Well, he may not have a job next year.
Well, yeah, we won't go into that. But certainly the whole notion of Australia having high prices is really a clickbait statement to a large degree. If we had high prices, surely we would have a sign of some sort of imbalance in the capacity of mortgage holders to hold on to their properties. But we still have record low levels of defaults and arrears. Really, defaults and arrears only rise as the economic cycle falls and unemployment rates rise. And it's because we have that very strong banking sector that doesn't allow us to overborrow. So prices are really a factor of those 80% LVRs and the 25% restriction on the proportion of our income that we can have as a repayment for our mortgage. So as long as those remain solidly intact, which they do, we can't notionally be over borrowing. So prices have a sort of a natural stabilizer, and prices will rise as the Reserve Bank changes interest rates, rise or fall, because the only thing that can change in terms of your borrowing capacity is your mortgage rate or your income. Now, incomes don't move as to the same substantial extent that or have the same impact that interest rates do, but certainly interest rates are an important driver of house price movements, particularly on the upside. But there's no doubt that, we have a shortage of houses in this country. You just have to look at the rental market, houses and apartments, to see that going through the roof. And getting back to the role of the Reserve Bank and others, similar policymakers in that particular decision. The Reserve Bank was part of the cheer squad that restricted finance to investors back in 2015-16. And now we're getting some sort of gobbledygook explanation as to why we have high rents and this notion of high house prices. Perhaps the Reserve Bank should forget about the dialogue and the narrative regarding Australia's housing markets and get on with the business of looking after the economy.
Well, also last week, the latest labour market data came out, and unsurprisingly, it remained consistent with a really tight labour market. But the headline said unemployment ticked up higher to 3.5%. Wow. But broadly, Australia's labour market's exceptionally tight, Andrew.
Yeah, fantastic result again, Michael. If you want a job, there's plenty out there. It's a very tight market. I think the interesting point with the latest data, Michael, was that the unemployment rate really ticked up as a result of the rise in the participation rate, whereas the previous month, we actually had our all-time low unemployment rate on the monthly basis, and that followed a fall in the participation rate. So I think we've now reached probably our baseline full employment number. because we just don't have the capacity to pull in unless we start to really see some impact from migration. We just don't have the workers anymore. So we're going to see that the unemployment rate will rise and fall based on what's occurring with the participation rate. And of course, the whole plan of higher interest rates is to soften demand.
Well, what I also found interesting was that full-time employment jumped by close to 60,000 jobs, and there were fewer part-time jobs. So people are working longer hours, and it seems that taking time off for COVID and illness seems to be decreasing a bit as well.
Yeah, and we shouldn't be quibbling, Michael. These are great results, and we have a very strong economy. And that's probably one of the reasons why we're seeing housing markets stand up, despite all the usual clickbait of doom and gloom, and perhaps some of that came from the Reserve Bank governor in his previous non-forecasts. Markets are turning over quite reasonably at the moment, particularly the big markets of Melbourne and Sydney that have led the charge downwards through winter with higher rates.
Well, one of the ways we keep a track of what's actually happening in the market rather than waiting to see house price statistics is seeing what happens each Saturday in the auction markets, because that's a real good indication of how people are feeling at the moment. And despite a lot more properties being on the market, particularly last weekend in Melbourne because of the Super Saturday before our grand final, auction clearance rates stood up very well, didn't they?
Well, they have, Michael. And speaking of Melbourne, they did have their Super Saturday, probably a little bit lower the numbers than we expected, but still well above the previous weekend. And the numbers were high. Let's not sort of quibble about that also, that auction numbers, nearly 900 auctions, is a good challenge for the market. And the market responded with a higher clearance rate. The Melbourne market has been particularly resilient through winter. It has tracked between the low to the mid-60s consistently. Now, that still represents what we'd probably still describe as a buyer's market. But once we get consistently at 65%, Michael, it is really probably the neutral zone in terms of housing market activity, where prices are generally not rising or falling. And our latest data is showing us that Melbourne house prices are not falling at the same level on a week-by-week basis, though they're improving, still falling. But now monthly price declines are looking like they're heading between 0 and 1%. That's a very solid result for Melbourne in this correction phase. And Sydney also, Michael, had another big weekend in terms of auction numbers, nearly 700 auctions, but it actually held its own, Michael, and recorded a 65% clearance rate. So again, the Sydney market's also consolidating to some degree in that sort of neutral zone. Now, early spring markets typically favour sellers, and clearance rates tend to fall as spring progresses. So it'll be interesting to see if that holds true going forward now, particularly in an environment where there's still a lot of negativity, where we will see interest rates continuing to increase. And look, the next few weekends, again, will be salient in terms of what's being revealed in the market. And next weekend, we'll probably have around 800 or 900 auctions in Sydney in its Super Saturday, its first Super Saturday of the year. So that'll be, again, a big challenge for the Sydney market. And, if it can maintain another mid-60-ish type of result, I think we can really start to feel that these markets aren't as spooked as some would expect them to be. And the other smaller markets also produce some reasonably healthy results. And Brisbane sort of back in town with a higher number of auctions and also a higher clearance rates. And Adelaide remains the top performer, still producing clearance rates around 80%, which is quite remarkable. And Canberra is certainly in pause mode at the moment.
I think, as we've said in previous weeks, the markets haven't bottomed, but they're searching for one. They're looking for one. They're not heading down fast, are they?
No, this isn't at this stage a rerun of 2018, when we had a similar sort of negative mindset and a lot of very concerning headlines at that time regarding the outlook for house prices. The market seems to be shrugging that off, and I think it's a factor in what is still a very, very strong economic environment out there, Michael. So at the end of the day, people are getting on with their lives, and perhaps they're a little bit immune to all the scaremongering that we had through COVID, and they're maybe starting to ignore what they're reading in the media to some degree.
Well, that would be good, because if history teaches us anything, it's that the media is consistently wrong. But unfortunately, our memories tend to be short, and that's why we get together each week here to give our thoughts and opinions on what's happening in the property market. So I look forward to catching up with you again next week, Andrew.
Thanks, Michael. Thanks a lot.